Welcome to the deep dive. Today we are strapping in for a really necessary and detailed look at a company that just perfectly captures the market's current obsession with future tech.
That's right.
We're talking about Rigetti Computing, ticker symbol RGTI.
A stock that is, it's right at the heart of the quantum computing revolution. It promises to change everything.
It does. But the thing about investing, especially in this kind of deep tech, is you always have to navigate this huge gulf between the vision and the cold, hard numbers.
And in Rigetti's case, that gulf isn't a gulf, it's a chasm.
Exactly. So we're tackling the central paradox right up front. As of late November 2025, Rigetti has this staggering market valuation of nearly $7.8 billion.
Billion with a B.
Yeah. That puts it in the same league as, established, successful mid-cap companies.
Yeah.
But then you look at their actual performance.
And the numbers just tell a completely different story.
Their revenue for the third quarter of 2025 was a mere $1.9 million.
That kind of disconnect is, it's almost unprecedented in traditional finance. It means the stock is trading at a price-to-sales ratio that's getting close to 1,000 times revenue.
1,000.
So you can't even analyze this like a normal business. You have to treat it like an early-stage venture capital bet.
So our mission today is clear. We are going to unpack the entire investment thesis. We're going to apply the strict, disciplined framework of classical value investing.
What Benjamin Graham or Warren Buffett would look for.
Exactly. And then we're going to augment that with a deep tech analysis to try and figure out what the market is thinking. Why is this valuation so incredibly high when the financials are suggesting, severe peril?
The source material is just brutally honest here. It forces us to categorize this as, and this is a direct quote, speculative high risk.
And profoundly unsuitable for conservative portfolios.
Absolutely. So we need to figure out if there's any rational, non-momentum argument that could possibly justify this kind of market cap.
It's going to be a fascinating journey through physics, finance, and, believe it or not, geopolitics. So let's get into it. Part 1, chapters 1 to 3, business, management, and financials. Chapter 1, business understanding.
Right, so if you really want to get Rigetti, you first have to understand the one huge strategic bet that defines everything about them.
Their cost structure, their opportunity, their risk.
All of it.
And that is 1.1, the vertical integration gamble, Fab 1. This isn't just a software play. They went all in on hardware. They built and operate their own quantum device factory in Fremont, California.
And this was very intentional. This is their strategic mode. Quantum processors, QPUs, are not like regular computer chips.
You can't just send the designs off to a standard foundry.
No, not at all. You're dealing with exotic superconducting materials like niobium, and you need specialized fabrication processes. So Rigetti's whole rationale is that by controlling the entire stack.
From design to building to testing.
That whole design, build, test loop, yeah. They believe it lets them iterate much faster and maintain a technical lead. And that rapid cycling is absolutely crucial when the fundamental technology is, still being figured out day by day.
Okay, that makes total sense from an engineering perspective.
Yeah.
Control your supply chain, control your destiny. But let's talk about the financial reality of that. What does it actually cost to own and run a factory like that?
Well, it creates a catastrophic fixed cost burden in the current environment. A quantum fab, unlike a software company, has immense constant operational costs whether you sell one chip or 1,000.
So what are we talking about here?
We're talking about highly specialized, multi-million-dollar equipment, things like electron beam lithography machines, and critically, maintaining these ultra-high vacuum environments and massive dilution refrigeration systems.
8 to qubits near absolute zero.
A fraction of a degree above 0 Kelvin, and those refrigerators alone, just running and maintaining them, must cost an absolute fortune. And you have huge depreciation expenses on equipment that is bespoke and might be obsolete in a couple of years. Plus the cost of the labor engineers who understand both quantum physics and cryogenics.
So when Rigetti only brings in $1.9 million in revenue in a quarter.
Fab 1 is running at a utilization rate that is, for all practical purposes, 0. This is the textbook definition of severe negative operating leverage. The fixed costs are just crushing their financials and dragging down any potential return on invested capital.
Because the factory is basically being subsidized by investor money, not by customers.
Precisely. It sounds like they're paying the price of being first, building the infrastructure before the market is even really there.
So let's look at what they're actually building. 1.2 technological roadmap, Anka to Cepheus. They chose superconducting qubits, which puts them in direct competition with giants like IBM and Google.
They're definitely in the mainstream, which is risky, but it's also a path that's been validated by huge R&D budgets from the big players. Their current focus is the 84-qubit Ankaa-3 system.
And the big technical milestone they hit in mid-2025 was achieving a 99.5% median 2-qubit gate fidelity.
Yes, and that number is critical.
Okay, for the listener who isn't deep in quantum physics, why is that specific number, 99.5%, so important?
So, gate fidelity is just a measure of how accurately the quantum computer does a basic operation. If your error rate is too high, the mistakes build up in a complex calculation and the answer becomes useless noise.
I see.
To get to true, useful quantum computing, what we call fault tolerance, you have to be able to implement quantum error correction, or QEC. And the threshold for that to even work is extremely high. Hitting 99.5% brings them a big step closer to being able to build stable logical qubits out of these, imperfect physical ones.
But the source material also points out that their main competitor, IonQ, is claiming even higher fidelities with a different technology.
That's the classic trade-off. IonQ uses trapped ion systems. They often have higher fidelity, meaning fewer errors, but they tend to be much, much slower. Superconducting qubits, like Rigetti's, have historically been a bit more error-prone, but they have much faster gate speeds, so you can potentially do calculations faster overall. Rigetti is betting they can keep pushing that fidelity number up while keeping their speed advantage.
And this is where their big technical bet gets really interesting. The pivot to modularity, the Cepheus-1 architecture.
Exactly. This is their engineering solution to the scaling problem. The fundamental issue in building bigger quantum computers is yield, as you try to cram more and more qubits onto a single monolithic chip.
Say, going from 84 to 500 qubits.
The probability of a tiny defect ruining the entire expensive processor goes up exponentially. It becomes almost impossible.
So they stopped trying to build one giant chip.
They pivoted. The new concept is to connect multiple smaller, high-yield quantum chiplets together into one big logical processor. They actually demonstrated this with a 36-qubit system as a proof of concept for Cepheus-1.
And that's their big bet.
This tiling approach is their technical call option. It's the hope that they've found the only viable path to scaling up to thousands of useful qubits by bypassing that exponential yield problem.
That's a powerful story, but the market needs revenue now. Which brings us to 1.3 commercial pivot, hardware sales versus cloud services. The original plan was different, right?
That's right. The original model was quantum cloud services, or QCIAS, high-margin recurring revenue where customers rent time on the quantum computer by the minute.
But that's not what they're doing now.
No, we saw a dramatic pivot towards directly selling the physical hardware, specifically the 9-qubit Novera QPU system to labs and universities.
And that pivot actually got them some results. They generated $5.7 million from selling just 2 of those systems in late 2025. For them, that's a huge lump sum.
It absolutely provided some much-needed cash, and, it validated that their hardware is reliable enough for research buyers to want it on-premise.
But there's a downside to that shift.
A big one. We have to analyze the implication here. By selling hardware, Rigetti has effectively turned itself into a lower-margin capital equipment vendor. They're giving up the dream of that sticky, high-margin, recurring cloud revenue.
And why would they do that?
Because that cloud model wasn't scaling fast enough to cover the massive cash burn from Fab 1. It feels like a tactical retreat, a move they had to make because of the financial clock, not because it was the best long-term strategy.
It definitely underscores how hard it is to get big companies to sign multi-million-dollar cloud contracts when the actual utility of the machine is still so debated.
And that brings us to the biggest risk factor for the whole industry. 1.4, the elusive definition of utility.
The valuation of every single quantum stock is based on the timeline to quantum utility, the moment the machine can actually solve a problem that a classical computer can't.
And that timeline got a huge, painful reality check in January of 2025.
The NVIDIA CEO, Jensen Huang.
His public comment that very useful quantum computers were likely 20 years away was an absolute earthquake for the sector.
That one comment triggered a 45% collapse in Rigetti's stock price. It led directly to class action lawsuits. Why such a violent reaction from the market?
Because it just completely breaks the valuation model. For a value investor doing a discounted cash flow analysis, if you push significant profits out by 2 decades,
20 years in the future.
when you discount those future profits back to today at any reasonable rate, the net present value just collapses. It goes to almost zero. If you believe him that the real payoff is 20 years away, then the current $7.8 billion market cap is mathematically indefensible today.
So Rigetti's counterargument is this idea of narrow quantum advantage.
Right. Find niche specialized problems like chemical simulation or certain financial models where you might see utility much sooner.
But are they finding them?
That's the path they have to take, but the structural issue remains. That shrinking revenue base we've been talking about suggests that even those niche customers aren't scaling up their spending. The whole industry seems to be in a wait-and-see mode, and that's just a killer for a company like Rigetti.
Chapter 2, Management Evaluation.
Okay, now we shift from the tech to the people running this high-stakes cash-burning operation. And here, the source material shows some significant turbulence, which is always a warning zone.
2.1, Leadership Transition and Turbulence. They moved on from the founder, Chad Rigetti, to professional operator Dr. Subodh Kulkarni, who became CEO in December of 22.
And that transition was, it was strategic. Kulkarni comes from manufacturing-focused companies like Cyber Optics and 3M.
So the idea was to bring in someone with manufacturing discipline to operationalize Fab 1.
Exactly. On paper, he's the right person to try and make that expensive factory work economically.
But the rest of the C-suite has been a revolving door. We noted a complete turnover. The current CTO, David Rivas, and the CFO, Jeffrey Bertelsen, they only joined in 2023.
Right. And that is not the kind of stability you want in a company that is making these massive decade-long technical bets.
What does that signal to you?
It signals potential strategic disagreements, it signals execution problems, or just a failure to agree on the real timeline to making money. It suggests the current team is managing a desperate turnaround, not overseeing smooth, predictable growth.
And the actions of this new C-suite are a major concern, especially when we look at 2.2 insider behavior, the rush for the exit.
This might be the single most potent non-financial red flag in this entire deep dive.
That's a strong statement.
Well, our sources show a significant wave of insider selling reported in November 2025 through Form 144 filings. And this selling happened to coincide directly with a recent run-up in the stock price.
Yet it's who was selling that's critical. It was the CTO, David Rivas, and the CFO, Jeffrey Bertelsen.
The two people who know the technical feasibility and the cash runway better than anyone on the planet.
Wow.
Look, executives are allowed to sell shares, of course, but the timing here, selling into a rally, specifically by the head of tech and the head of finance, that gets scrutinized very, very heavily.
It's the potent warning we mentioned.
It is. Why would the technical leader and the financial leader choose to cash out now if they truly believed a breakthrough was right around the corner that would send the stock up 10x or 100x?
It really supports that bearish idea that management is feeding the ducks.
Yeah.
Taking advantage of the retail hype to cash out at high prices.
And this is made worse by the poor alignment. Insiders own less than 1% of the company directly.
Less than 1%.
It's a classic recipe for a principal-agent conflict. When management has so little skin in the game, their incentive might shift from maximizing long-term shareholder value to just maximizing the short-term value of their stock options.
Which means pumping the stock price instead of making prudent long-term decisions.
Precisely. And finally, under this governance banner, there's 2.3 legal and governance risks. That class action lawsuit is still hanging over them.
Stemming from that 20 years to utility comment.
Exactly. The lawsuit, led by the Rosen law firm, alleges that the company made misleading statements about how close they were to commercial viability.
That strikes right at the heart of investor trust.
It does. And a cash-burning company just cannot afford this kind of reputational damage. Even if they win the lawsuit, the legal costs, the distraction, the management time, it's a massive drain on a company that is already operating on a very short, very fixed cash runway.
Chapter 3. Financial health.
Yeah.
All right, this is the chapter where the whole valuation story really just collapses under the weight of reality. We have to look past the exciting physics and focus on the numbers required to keep the lights on.
And it starts with 3.1 income statement forensics, the shrinking top line. This is the fundamental contradiction. We are analyzing a growth stock that is actively shrinking.
Let's break down that revenue erosion. After they went public via SPAC, they peaked in 2022 at $13.1 million in revenue. That already dropped to 10.8 million in 2024.
But it's the acceleration of that decline that's so alarming. The trailing 12 months revenue as of November 2025 is only between $7.5 and $8 million.
That's a decline of over 30% from their peak, in a market that analysts claim is growing at 30% a year.
And that third quarter of 2025 was just brutal. Only $1.9 million in revenue, a 37% drop from the prior period.
It's an oxymoron, accelerating negative revenue growth in what's supposed to be a revolutionary tech sector.
It strongly suggests that either their technology is falling behind commercially, or the entire early adopter market they were targeting is just drying up. They aren't just failing to grow, they are actively losing scale.
And to maintain that declining revenue, they are just hemorrhaging capital. Let's quantify the burn rate.
The operating deficit is structural and it's severe. In Q3 2025 alone, R&D cost them $15 million.
$15 million.
And SG&A, selling, general, and admin costs added another $5.9 million.
So you're looking at a total structural cash burn of roughly $20 million per quarter.
That's $20 million going out the door every 3 months, whether they sell an Avera or not.
Which leads directly to 3.2 cash burn and liquidity runway. We need to know exactly how long they can keep that up.
As of September 30, 2025, their total liquidity was about $137 million.
Okay, let's do the math for you. $137 million in the bank, divided by a $20 million quarterly burn.
The runway is only 6 to 7 quarters. That's it.
Wow.
It projects a cash-out date in early to mid-2027. This isn't some abstract projection. This is the hard clock ticking on their existence unless they get a fresh infusion of capital.
Now, one small positive is their debt status. They did repay some debt, right?
They repaid the Trinity Capital debt, which is good. It removes a significant interest burden. But it also means they have very limited capacity to take on new debt.
So when that runway ends in 2027, the only path forward is equity.
The only feasible path is 3.3 capital structure and inevitable dilution.
And they have a history of doing this.
Yeah.
We saw that massive at-the-market equity offering back in Q4 of 2024.
That ATM offering where they can just dribble shares into the market over time was a necessity. It raised $150.3 million, which sounds great, but it required them to sell 88.1 million new shares to do it.
88 million shares. I mean, let's quantify that. That just massively dilutes every single existing shareholder's stake.
It does. And critically, given that 6 to 7 quarter clock and their failure to get anywhere near profitability, further dilution is not a possibility. It is a mathematical certainty.
So anyone investing today has to factor in a likely 20 to 30% reduction in their ownership stake over the next couple of years.
At least. Just to finance operations and keep the R&D machine running.
And now, let's bring it all back to where we started. 3.4 valuation metrics. The absurdity of 975x sales.
This is the number that proves this investment is right now entirely divorced from financial reality. You take the nearly $7.8 billion market cap, you compare it against the roughly $8 million in trailing revenue.
And you get a price-to-sales ratio of almost 975x.
I mean...
Let me push back, though. In disruptive tech, can't metrics like PS be misleading? Isn't growth supposed to be exponential, not linear?
That argument completely falls apart when your revenue is contracting, not growing. Even the most aggressive, hyper-growth software stocks at the peak of the 2021 bubble rarely traded above 50 or maybe 100 times sales.
Yeah.
For a company with negative growth, a 975x PS suggests the market isn't pricing in growth, it's pricing in perfection. A winner-takes-all scenario where Rigetti has already solved quantum computing and captured the entire future market.
So just to put this in perspective, if Rigetti were to trade it at, let's say, a very generous but still rational 50x sales multiple,
Which is very aggressive for what is now a hardware vendor.
their revenue would need to be $156 million today.
Yeah.
Almost 20 times what it actually is, just to justify the current valuation.
That is the cold, hard reality. The valuation lacks any precedent in classical finance. It confirms that this stock is trading purely on momentum, speculation, and hope.
Like and subscribe to Stock Analytics AI. For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
Okay, so we've established the financials are, well, they're toxic. So why is the stock still holding such a high price? To understand that, we have to look at market dynamics and competitive positioning.
Let's start with 4.1, the competitive hierarchy and revenue capture. The big picture story is positive. Analysts are projecting aggressive market growth for quantum rights.
They are. CAGRs between 20 and 35% through 2030. But that's a deceptive tailwind. Most of that money is flowing into research grants or the internal R&D budgets at places like IBM and Google.
Not into commercial purchases from a pure play like Rigetti.
Exactly. It leads to this profitless prosperity where the narrative around the sector gets better and better while Rigetti's actual top line gets worse.
And the competitive gap is glaring when you make the IonQ comparison. IonQ, using trapped ion tech, generated $39.9 million in Q3 2025 revenue.
Right. And you contrast that with Rigetti's $1.9 million in the same quarter. IonQ's revenue is almost 20 times greater.
That's a huge signal from the market.
It's a critical signal. It suggests the market today views trapped ion technology as significantly more commercially viable in the near term. Customers are actually willing to write big checks for what IonQ is selling right now.
But wait, what about Rigetti's long-term bet? That modular Cepheus architecture. If they solve scaling with chiplets, couldn't they just leapfrog IonQ?
That is the bull case. That is the real option argument we'll get to. But the market, with its spending, is basically saying, we prefer 5 times fewer errors from IonQ over 10 times faster gate speed from Rigetti for what we're trying to do today.
So Rigetti might have the better long-term solution.
But if they run out of cash in 2027 trying to prove it, it doesn't matter. The revenue gap right now shows they are losing the near-term commercial race and losing it badly.
Moving on to 4.2, volatility and technical indicators. This is not a stock for the faint of heart.
The beta of 2.26 confirms that. For every 1% move in the S&P 500, Rigetti theoretically moves more than 2%. It is just hypersensitive to macro news, sentiment, and speculative momentum.
And looking at the price action, it's at $24.15. It looks like that recent rally has faded.
It has. The price is well below the 50-day moving average of $35, which is a classic sign of a correction.
Right.
But it is still above its 200-day moving average of about $17.80.
So what does that tell you?
It suggests the fast money, the momentum traders are getting out, but the long-term believers who bought at the bottom are still holding on. The RSI, the Relative Strength Index, is around 44, which suggests the selling has eased up, but there's definitely no buying frenzy anymore.
And let's look at where the smart money is placing its aggressive bets. 4.3 short interest dynamics.
This really confirms the bear case. We're seeing substantial short interest, somewhere between 12% and 17% of the float. That's a high number.
And that means
It means a significant chunk of sophisticated capital has borrowed shares and sold them, betting that the price will eventually collapse back towards its fundamental value or, lack thereof.
But as you said, high short interest is a double-edged sword. It creates the risk of a short squeeze.
Oh, it creates incredibly dangerous conditions for the shorts. If Rigetti were to announce, say, a surprise breakthrough with Cepheus or a huge government contract, those short sellers would panic,
They'd have to rush to buy back the shares.
creating intense vertical buying pressure. So the high short interest validates the bear case on fundamentals, but it simultaneously ramps up the volatility and the technical risk for everybody involved.
Chapter 5. Ownership structure. Here we see this really crucial disconnect between who is buying and who is selling this stock.
5.1, the divergence.
Passive plot.
Passive buying versus active selling. We already covered the aggressive selling signal. The insiders, the executives are selling. And they own less than 1% of the company to begin with. The people in charge are reducing their exposure.
But countering that, you see these massive, steady inflows from the biggest institutions in the world. 5.2 institutional inflows versus mandate. We're talking about Vanguard and BlackRock consistently increasing their positions.
And this is a critical distinction for you to understand. These inflows are overwhelmingly passive buying.
What does that mean?
It means Rigetti is part of certain small-cap stock indices, like the Russell 2000. So the passive managers at Vanguard and BlackRock who run funds that just track that index, they are forced to buy and hold Rigetti shares.
Regardless of whether they think it's a good company or not.
Exactly. The average investor sees BlackRock bought 1 million shares and thinks it's a vote of confidence.
But it's not.
That's the liquidity trap. In reality, the fund manager might think the stock is absurdly priced, but their mandate forces them to buy it anyway. This passive buying provides a steady stream of liquidity at these elevated prices, which allows the insiders, who know the real risks, to actively sell their shares and get out.
So always filter those institutional filings. Is it mandate or is it conviction?
For Rigetti, the biggest buyers are buying out of obligation, not belief.
Chapter 6. Risk assessment.
Okay, now we need to look at the risks Rigetti faces that are completely outside of their control, things they can't fix with better engineering.
Macro and geopolitical forces.
Starting with 6.1 geopolitical risk, the Trump 2.0 trade doctrine. The political shift in late 2025 has created immediate supply chain problems, especially with China.
This feels like an unquantifiable but potentially huge risk.
It's existential. The administration finalized the Section 301 tariffs, and that put a 25% levy on critical minerals. That includes indium, tungsten, and tantalum.
And why are those specific minerals so vital for Rigetti's chips?
Let's just focus on indium. It is absolutely critical for creating what are called superconducting bump bonds. These are the tiny connectors that link the quantum chip to its packaging inside that super-cold refrigerator.
Okay.
It's also needed for the cryogenic seals that maintain the vacuum. Without a reliable supply of highly refined indium, Fab 1 cannot produce its QPUs, period.
And China dominates the global supply of refined indium.
Completely. So the immediate hit is cost inflation, a 25% price hike on a critical material. But the existential threat is a full export ban from China.
Similar to what we've seen with other rare minerals.
Exactly. If China bans the export of indium, Fab 1 could face production stoppages within months. And that's a risk that has absolutely nothing to do with the quality of their physics.
So a geopolitical decision made in Beijing could render their $7.8 billion valuation worthless.
It could. It forces them to find more expensive, less reliable non-Chinese sources, which adds cost and delays their roadmap.
Now let's look at 6.2 macro risk. High cost of capital. The broader financial environment is just punishing for companies like this.
The 10-year U.S. Treasury yield, hovering around 4% in November 2025, is kryptonite for what we call long-duration assets. And Rigetti is the ultimate long-duration asset.
Explain why high interest rates hurt them so much more than a typical company.
It's all about the discount rate. Because Rigetti is so volatile, investors demand a very high rate of return to own it, probably 15 to 20%. When you take their theoretical future profits from, say, the year 2035, and you discount them back to today at a 20% rate,
the present value just collapses.
it collapses. The high interest rate environment fundamentally undermines the speculative story by making future potential worth dramatically less in today's money.
And finally, the deepest risk of all, 6.3 scientific obsolescence risk, the binary bet.
This is it. Rigetti has bet the entire farm on one horse, superconducting qubits, all housed in Fab 1.
So if a competitor, using a totally different approach, like Microsoft with topological qubits or Sequantum with photonics, has a breakthrough first,
The entire superconducting infrastructure, Fab 1, all that expensive equipment, all of it could become scientifically obsolete overnight. This is the unhedgeable risk of deep tech. They've put all their chips on a single path.
and unlike their rivals, Google or IBM, they can't just absorb that kind of failure.
Precisely. If investor confidence in their approach disappears, what they call a quantum winter, the big guys can just keep their research going. Rigetti, with its $20 million quarterly burn and its 6-quarter runway, is disproportionately threatened. They are on a timer, and if that substitution risk hits, it's terminal.
Chapter 7, Conclusion.
Okay, we've gone through every part of the business. Now we synthesize all these findings to deliver our final judgment on Rigetti Computing as an investment.
7.1 Synthesis, the value investor's nightmare. Let's just quickly run through why RGTI fails every classic test of a sound investment.
It fails on 4 key metrics. First, understandability. The business relies on unproven, highly speculative future tech. Second, sustainability. Revenue is contracting, and their supposed moat, Fab 1, is a financial liability.
Third, beating management integrity. The executives who know the most are selling their shares.
And fourth, valuation. Trading at 975 times sales, the price is just completely disconnected from any measurable financial reality.
So given that total lack of fundamental support, why is this company worth anything at all?
7.2, the real options counterargument. This is the only rational framework for owning this stock. It's called real options theory.
What does that mean?
You're paying an exorbitant premium for the option to own a slice of a potential winner in the future of computing. If Rigetti, against all odds, succeeds with their Cepheus scaling where IBM and Google fail, the payoff could be asymmetric. It could be 100x.
But the clock on that option is ticking very, very loudly.
It is. The option has a clear expiration date, It's tied directly to that 6-7 quarters of cash runway. They absolutely must secure huge contracts, achieve a commercial breakthrough, or dilute shareholders again before mid-2027.
Let's move to the 7.3 final recommendation and actionable advice. Based on all this, what is the clear rating?
The rating is an unequivocal sell avoid. For any investor who cares about capital preservation, this security is simply uninvestable at its current price.
The price already assumes they've won.
It assumes they've solved quantum computing and beaten every competitor.
So what's your advice for existing holders who might have gotten caught up in the hype and seen this recent price spike?
The advice is tactical. Use this price spike and the passive institutional buying as a rare opportunity to get out or drastically reduce your exposure. Take the capital that's tied up in this gamble and move it into assets whose valuations are connected to reality.
And for new speculators who are tempted by that 100x return story?
You have to recognize this for what it is. Treat any money you put in as lost capital. A tiny part of your portfolio, less than 1%, that you are fully prepared to lose entirely.
It's a gambling token, not an ownership stake in a business.
That's exactly right. And the single most important thing for you to watch over the next year is the revenue line, Q4 2025 and Q1 2026. The company is in the valley of death until revenue starts growing again. If that number keeps shrinking, the odds of a collapse go up exponentially. Rigetti Computing is a scientifically fascinating endeavor. It truly is. They are trying to solve some of the hardest problems in the world. But as an investment today, it is structurally flawed. The disconnect between its immense technological potential and its current perilous financial reality is just fundamentally and mathematically unsustainable.
Like and subscribe to Stock Analytics AI. For €4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next. Plus, members-only requested deep dives. Thank you for joining us for this deep dive into the paradoxical world of Rigetti Computing. Remember, all the information presented today is based on extensive analysis of publicly available data and AI research source material.
And this is not financial advice. Always conduct your own exhaustive due diligence before you make any investment decision. We will see you next time on The Deep Dive.